Hello. Welcome to Ion Trades. Today, we're diving into the fascinating world of candlestick charts. Now, let's talk about candlestick charts. What are they, and why are they such a fundamental tool in the world of technical analysis? At its core, a candlestick is a visual representation of price movements of an asset for a given period. It is commonly used in technical analysis to visually show the price action of an asset within a specific time interval. It's like a snapshot of the battle between buyers and sellers during a specific time, whether it's a minute, an hour, a day, or more. Candlestick charts are widely used in various financial markets, including stocks, forex, commodities, and cryptocurrencies. Now, let's break down a candlestick. Each candlestick has three main parts: the real body, the upper wick or shadow, and the lower wick or shadow. The real body represents the opening and closing prices, while the shadows show the highest and lowest prices reached during that time. Now, let's focus on the real body of a candlestick. It's a key element that reveals a lot about the dynamics between buyers and sellers during a specific time frame. So, what exactly is the real body? The real body is the rectangular-shaped area between the opening and closing prices of a candlestick. The length of the real body is crucial. It represents the price movement within that chosen time, whether it's a minute, an hour, or a day. Long versus short real bodies. Real bodies come in different sizes. A long real body indicates a significant price movement during the time, signaling strong conviction among buyers or sellers. Conversely, a short real body suggests indecision or a relatively small price movement, indicating uncertainty among market participants. So, why does the real body matter? It gives us insights into the dominance of either the bulls, buyers, or the bears, sellers. A long bullish real body signals strong buying pressure, while a long bearish real body suggests robust selling pressure. In contrast, a short real body may indicate a lack of conviction or a balanced tug-of-war between buyers and sellers. Think of it like this: the real body is the range between the opening and closing prices, and the shadows show how far the price swung up or down. The real body of a candlestick, a crucial component in understanding market sentiment and making informed trading decisions. Let's move on to the wicks. The upper wick. Let's start with the upper wick. This part of the candlestick represents the highest price reached during the given time frame. It's like a mark left by the bulls or buyers, showing how far they managed to push the price upwards before the bears or sellers stepped back in. The lower wick, on the flip side. We have the lower wick. This part signifies the lowest price reached during the time frame. It reflects the bears or sellers' attempt to pull the price down before the bulls or buyers regained control. The length of the wicks is crucial for interpretation. Long wicks suggest significant price volatility and indecision between buyers and sellers. Shorter wicks, on the other hand, indicate more decisive moves in one direction. And no wick means unidirectional dominance. Candlestick range. So, what exactly is the range in candlesticks? Well, the range refers to the difference between the highest and lowest prices within a specific time period represented by a single candlestick. It's like the price battleground where buyers and sellers duke it out. Take a look at this candlestick. The upper shadow represents the highest price reached during the period, and the lower shadow shows the lowest price. The body, of course, represents the opening and closing prices. Now, understanding the range is crucial because it gives us insights into market volatility. A wide range indicates high volatility, suggesting significant price movement during that period. On the other hand, a narrow range suggests lower volatility, signaling a relatively stable market. Why does this matter to you as a trader? Well, the range can help you gauge the strength of a trend. A wide range in the direction of the trend suggests a robust movement, while a narrow range might indicate a potential reversal or a period of consolidation. Bullish and bearish candlesticks. Candlesticks come in two primary colors to show the direction of the price movement: green for bullish and red for bearish. A green candlestick means the closing price was higher than the opening, a win for the bulls or buyers. Conversely, a red candlestick indicates the bears, or the sellers had the upper hand. In essence, a green candle signals a bullish market sentiment, indicating that buyers are dominating, while a red candle signifies bearish conditions, signifying that sellers are in control. So, just by looking at the color, you get a quick read on who dominated the market during that time period. Let's look at a bullish candlestick. Bullish candlestick. The open refers to the price at which an asset begins a specific time, typically at the start of a trading day. Now, let's examine the daily stock chart for Apple. This single candle symbolizes one entire day, and the opening price for that day was at $182. The close refers to the price at which an asset ended a specific time, often at the end of a trading day. Now, let's look at the daily stock chart for Apple. This single candle symbolizes one entire day, and the closing price for that day was at $177. The high represents the pinnacle, the summit, the highest price reached by an asset during a specific time. Imagine you're examining a stock chart. The high price is the maximum transaction value the asset achieved, capturing the peak of its value. Let's go back and look at the daily stock chart for Apple. This single candle symbolizes one entire day, and the highest price reached for that day was $177. The low signifies the floor, the lowest price reached by an asset during a specific time. Let's revisit daily stock chart for Apple. This single candle symbolizes one entire day, and the lowest price reached for that day was $173. In a bullish candlestick, the closing price is higher than the opening price, and the real body is usually colored green. Let's move on and look at the bearish candlestick. Bearish candlestick. The open refers to the price at which an asset begins a specific time, typically at the start of a trading day. Now, let's examine the daily stock chart for Apple. This single candle symbolizes one entire day, and the opening price for that day was at $181. The close refers to the price at which an asset ended a specific time, often at the end of a trading day. Let's look at the daily stock chart for Apple. This single candle symbolizes one entire day, and the closing price for that day was at $178. The high represents the pinnacle, the summit, the highest price reached by an asset during a specific time. Let's go back and look at the daily stock chart for Apple. This single candle symbolizes one entire day, and the highest price reached for that day was $181. The low signifies the floor, the lowest price reached by an asset during a specific time. Let's revisit daily stock chart for Apple. This single candle symbolizes one entire day, and the lowest price reached for that day was $178. In a bearish candlestick, the closing price is lower than the opening price, and the real body is usually colored red. And that, my friends, is the beauty of candlestick charts. They're more than just pretty patterns, they're a dynamic language that speaks to us about market sentiment, trends, and potential opportunities.